The points in this video help me frame potential investments and more easily reflect on my investing worldview. And unlike the majority of ticker content, it is neither strictly facts nor algorithmically generated. So are you really investing in your house? When I think of holding assets, I think about them in terms of saving, investing, and trading. Saving is merely the act of holding assets of financial value without the expectation of real growth. These assets can either be inflation-fighting, such as gold or low-risk bonds, or non-inflation fighting, such as cash. Always having liquid assets on hand ensures you're positioned to take advantage of a market correction. Trading and investing are employed to derive value above the rate of inflation. Investopedia defines the difference between trading and investing primarily by the length of the holding period, trading being short duration and investing being longer term. The difference as I see it depends on whether the asset has the ability to generate its own cash flow. Investing is about putting money into an asset which has an internal mechanism for turning invested money into more money. Trading is expressly about buying assets at one price and selling at another, regardless of intrinsic value generation. In short, if your asset is doing the work, you're investing. If you are doing the work, you're trading. Investing is an exercise in building compound returns through self-perpetuating asset growth. For example, when a company earns money, it can reinvest that money into R&D, new assets, or acquisitions that help improve its money-making capabilities. If a company you own shares in pays dividends, you can reinvest those dividends into more shares of the company. By owning more shares, you earn even more dividends. These are both examples of compounding growth thanks to cash flow. In other words, it's recursive value generation. Trading, as opposed to investing, is the act of buying and selling assets to take advantage of price movement, regardless of the asset's underlying value. A trader's goal is to purchase an asset, wait until it has increased in price, and sell it. Or in the case of short selling, to sell an asset, wait for the price to decrease, and buy it back at a lower cost. Trading and investing require entirely different mindsets and require entirely different actions in order to realize profit. Investors hold assets over time, while cash flow is reinvested, generating ever greater equity and cash-generating capability. Traders measure market sentiment through technical analysis and other methods, and calculate the risk of loss versus potential profit. Stop loss and take profit points are chosen ahead of time to mitigate the risk of emotional trading. The assets traders buy and sell are not required to have any intrinsic value whatsoever, only enough liquidity to trade it. So what do investable assets look like? Let's take a look at gold. In our framework, gold is like a currency, a saving instrument, or a store of wealth. Gold does no work and has no mechanism by which to grow or generate value on its own. That is not to say static assets can't appreciate in real terms based on external factors. Gold's price may fluctuate based on supply, demand for the physical material, and sentiment. But if you take advantage of these price fluctuations in order to earn profit, it is you doing the work. Hence, you are trading static assets such as gold. Conversely, stocks, bonds, and loans all generate cash and either reinvest internally or pay you directly. Even stocks that don't pay dividends are increasing cash holdings for future investments, are improving cash-generating capabilities, or are buying back stocks, increasing your stake in the company. All of these actions build a more solid base of value underneath your initial cash investment, through growth in equity or dividend payments. It is the operation of the business itself that generates value over time, making company stocks a real investment. Measuring the performance of businesses informs investors which companies to invest in. It's advantageous to base our definitions of trading and investing around the asset's ability to generate value internally, rather than base definitions on holding period. This way, the required mindset and strategies for investing or trading can be aligned with the motivations for holding the asset. Are you using the asset itself to accrue further value through its own internal mechanisms, or are you using it simply as a value-holding appliance? These two vantage points, that of the trader and that of the investor, frame the same assets in two different lights, making asset buying or selling decisions clearer in either light. If you are not conducting any analysis and going on gut instinct or what you hear in the news, this is called speculation. Speculation is the uneducated guessing that the majority of retail traders engage in. Speculators supply liquidity to markets and provide opportunities to informed buyers. There is one more asset purchasing activity I want to discuss: arbitrage. Arbitrage is taking advantage of an asset's price becoming decorrelated from an expected value. For example, so-called pure arbitrage is locating an asset that is sold in two markets, where there's a temporary price discrepancy between the markets, and buying or selling the asset in both markets simultaneously to lock the discrepancy into your profits. Due to the instantaneous nature of pure arbitrage, it is considered a risk-free trade. Pure arbitrage can be executed on stocks that are dual listed on two exchanges. However, with algo trading quickly executing trades and closing discrepancies, pure arbitrage is mostly out of reach for retail investors. Merger arbitrage is the act of identifying a company at risk of a takeover bid, determining the discrepancy between the current share price and the expected takeover price, buying the asset, and selling it when the price has reached the established takeover price. Arbitrage employs elements of both trading and investing, but as cash flow is not leveraged to build value over time, by our definition, arbitrage is a trading activity. So with these strategies in mind, can you really invest in a house? If you have no cash-generating mechanisms by which to value your home and you're relying on sentiment and price alone to determine your buying price, you might strategize like a trader. Consider city and countrywide sentiment trends, other markets, past performance, etc. You may even do technical analysis on market pricing. If you plan on renting your house or a portion, similar to dividend-paying stocks, you can employ a discounted cash flow model and calculate different property values based on the prevailing rent prices. If you plan on living on the property as well, you can even choose to add the rental value to the value you place on your living portion of the property. Given the tendency for real estate to appreciate, especially given rising populations and the availability of credit to more and more people, as well as migratory trends, I actually think of real estate purchasing more like arbitrage than investing. Real estate allows purchasers to compare very similar assets, housing, commercial property, plots of land, etc., across a multitude of markets in different parts of the market cycle. Let's compare all of these strategies in a final example. Imagine you purchased a $1 million mansion in rural Ontario, and suddenly an unforeseen event drives people out of cities into the countryside. In 5 years, your $1 million mansion appreciates by 80%. Meanwhile, urban prices have only appreciated by 30%. The pricing trends are unprecedented, and having done some research, you believe they are unlikely to last. As an arbitrator, you have the option to sell your mansion for a healthy profit and move to the city, returning to the country when prices have normalized. If you're thinking like an investor, you may decide to stay, renovate your basement, and take advantage of the elevated rental prices. As a trader, you may sell as appreciation slows, putting the profit into a more volatile asset class. As a saver, you may simply reside in your rocking chair, being happy to deal with none of it. This video is not really about property. The point is this. These strategies are not the same and should be wielded for different assets in different markets. Trading is about price movement. Investment is about finding fundamental value and leveraging cash flow. Arbitrage is about taking advantage of price discrepancies across markets. These strategies require looking at assets differently and using different datasets, valuation techniques, and risk analysis methods. Putting names to these strategies helps make them easier for savers, traders, or investors to think about the various benefits or drawbacks to combining each method, market, or asset. Whatever you think of these definitions for saving, investing, trading, or arbitrage, I hope to have convinced you of one thing. Next time you are considering buying an asset, be it a home, a stock, gold, or other commodity, consider whether and why the asset is worth money, or whether it is merely a vehicle for price movement. If you're interested in fundamental analysis and value investing, visit ticker.com/learn and check out our favorite books on investing, the investing mindset, and valuing companies. Ticker.com also indexes stocks based on algorithmic valuation. It is free to use. Links are in the description. Otherwise, check out this playlist for more insights into the world of investing. Ticker.com and Ticker Insider are intended for educational and informational purposes. Do your own research and consult a licensed financial advisor before making investment decisions.